All right, so today I wanted to make a video about a handful of different things. Number one, a mock portfolio update. Number two, just kind of an update on the market and my thoughts on things going forward here. So if we let's just get into the market first, because that's the easiest thing to start with. Again, the S&P hit an all-time high, the NASDAQ, and I think even the Dow on Thursday. It did pull back a little bit since then, but again, we still closed higher in the week. We're still up significantly on the year and on the month. So no one, like I've said time and time again, nobody knows when the market's going to top. Nobody knows anything about that. Trying to time the market is a terrible idea. My strategy, and again, if we wanted to get into that, my strategy is quite clear. In my personal portfolio, it's a little bit different than in this one because my personal money is virtually all of it is in a TFSA, and in a TFSA you cannot use put options, which is a big strategy I have in this portfolio. So again, the strategy is quite clear. Again, I do have positions in a handful of different companies. EQ Bank, I think, is actually you could be buying right now. I think it's if anything, I think it's cheap. I think EQ Bank is worth probably $110 a share. It's currently at about 83, 84. Skyworks, I think is worth more than where it is right now as well. Paycom Software, the low 200s probably. QLYS, definitely a little bit higher than where it is. ATD, probably about where it is. Microchip Technology, I think is definitely a little bit underpriced as well. The other ones, again, are slightly more speculative, I would say. CEIX, again, that's an energy play that I like. ARLP, again, that's another energy play that I think is decent as well. URA, again, that's a uranium play. That's one that I'm going to keep building out with put options. WTS, again, another one that I like long term. And then I have a little bit of BAM and a little bit of Brookfield, which, again, very small positions. I'm going to keep those pretty small as well. NAPCO Security, again, another one that is more of a speculative play that, again, I'm going to keep small as well. But again, the other thing that you will see here is virtually every position I have, I will be selling covered calls, and virtually every position that I enter, I use options to enter. Now, again, if you don't know what that means, again, there's put options, there's call options, right? Call options, again, is the right to buy at a certain price. Put options is basically saying, I want to buy, but I want to buy. If you were selling a put, I guess, is a better way of putting it, because I am selling puts and I'm selling calls. If you're selling calls, it's like, hey, I'm okay to sell the stock at X price. Typically, I'm going to buy that back anyway, so it's kind of irrelevant. It's just a way to generate income. And the put is kind of different in that the put is saying, hey, I want to buy this stock, but I want to buy it at a price that's lower than where it is right now. And in a market that is definitely a little bit overpriced to arguably highly overpriced, depending on who you talk to, that is the best strategy, because when you're selling options, you collect a premium in exchange for that. Right? So every single one of these options that I have sold, I have collected premium. I have gotten paid to sell the options. And that is the best strategy, in my opinion, in that I have two main strategies here. Number one, I have the vast majority of my portfolio is in bonds, namely SPHY. And this is a high yield corporate bond fund that, again, it's yielding about 7.5%. And if rates go down, the value of this ETF is going to go up. So my strategy is quite clear. I'm going to continue just selling puts. If the market stays expensive, it stays expensive. I don't care. If it comes down, then I'm going to get good quality companies at a fair price. I'll sell however much of this I need to sell to come up with the cash to buy the stock. And in the meantime, I'm going to get paid 7.5% to do so. That is my strategy, and I think that is a very, very, very good strategy. And during that time, I'm going to be keeping an eye, because like I said, I still think there is some stocks out there. I'd say maybe 10 or 20%, at least of the ones that I have that I'm watching closely, that you can be buying at current prices. But again, most of those I already own. And again, I want to keep in this portfolio, I don't want any single position to be more than about 5%. Then again, obviously these bond ones are more than that, but I'm talking, 5-10 years from now. I don't want any position to be more than that because, again, I want to be diversified, and I'm not a fan of being the guy that only owns like 10 stocks or 20 stocks. I like owning 30, 40, 50 stocks. I'd probably cut it off around there, but again, that's just an estimate. So again, I think that is the best strategy. And again, in my personal portfolio, this is my largest position. I bought more this week. It is now my largest position. And I plan on buying more until we get a correction. And again, going into that, this is a chart of the S&P 500's historical PE going back 10 years. And again, if you see, right now it's at 28.41. The only time when it's been higher than that was in November of 2020. Back then, stocks were certainly expensive, right? Stocks were, and this was going into 2021, basically, right? This was when the market previously topped. So we're not even close to there, right? We're not even close to there. And again, I think that there's a lot of people out there that are comparing right now to the late 90s, early 2000s, the tech bubble, right? And I think that's a completely unfair comparison. Number one, because the ratios are not that high, at least from what I've seen. And number two, a lot of those companies were not even making money. Like a lot of those companies were not even profitable. Nvidia is clearly very expensive, but it is making a lot of money. Microsoft, definitely expensive, but it is making a lot of money. So comparing this to the tech bubble, I think is not a good comparison, right? It's not a good comparison because it's just not accurate. I think that the market is probably 5 to 10% overvalued right now. So we would probably need to correct down to the high 4,000s on the S&P to be fairly valued. And again, you also have to keep in mind things like PE is not the perfect metric because PE doesn't account for earnings growth. Because if you have a company that's growing earnings at 20% per year that has a 28 PE, and a company that's growing at 5% per year that has a 28 PE, those companies are not the same. So that's something you have to keep in mind. It's not the perfect comparison. And again, if we let's compare price to sales. Again, also not a perfect comparison, but if we go back 20 years, again, the highest it got December of 2021 at just over 3. It's currently at 2.8. If we go back, let's say 10 years, your average, you're probably looking at a little bit over 2, right? So it'd have to come down about 0.5, right? So again, I don't think we're egregiously overvalued. I think that, again, like I said, I think we're 5 to 10% overvalued. And my rough thought on this is, for every 5% the market pulls back, I would probably sell about, 25 to 30% of these top 3 positions, and then allocate those to stocks. But the beauty of this strategy is you don't have to time the market. You simply just sell your puts at reasonable valuations, because you have to make sure you're not selling at like 2% below on Nvidia, right? If Nvidia, I don't even know where Nvidia is at off the top of my head, but if it's at 800 and you're selling like a 790 put, like that, I don't think that's a good idea. But I think I have a 500. Let's check and see here, because I did actually sell an Nvidia put. $495, and again, Nvidia is, again, I'm currently up $180 on that position too. So that is the beauty of selling puts. Again, I think that this is just a perfect strategy. The one problem, like I said, is that a lot of the tax sheltered accounts, you can't do this. So the realm for that is simply just to hold the bonds. Again, a lot of people will just hold T-bills. I think that that's an option too. But in my opinion, you're giving up yield, because T-bills are going to be yielding around 5%, maybe just over 5 if you're lucky. And why would you do that when you can get 7.5% on these, the high yield ones? So again, I might even sell the T-bill ones here because I think that you can get a better yield here. USHY, I think it's about 6.5-7%, so it's not quite as high, but the duration is a little bit shorter, so that's why I think that the yield is not quite as high, because the duration is a little bit shorter. So that is the strategy. That is the strategy. I think it's a brilliant strategy. Again, if you look at the portfolio here, if I were to do this over the next year, you'd be getting $56,000 in dividends. Again, the current yield on cost is, or the yield on cost is 6.08%. So again, I'm basically getting paid 6% to wait for a market correction. In my opinion, that is an absolute no-brainer. That is an absolute no-brainer. Again, a lot of people say, "Oh, you're young. Why don't you just invest?" And again, I think that this is still the better strategy. One fundamental philosophy that I have, honestly, is do not overpay, especially do not egregiously overpay for stocks. That's one position that I'm very, very firm on when it comes to my investing, is I will not overpay. Maybe a tiny bit, but not anything egregious, right? And I think we are at that level. I think that if the S&P went below 5,000, I think that's when I would definitely become interested. If it went 49, 48, then I would start to get interested. If we went down to the mid 4,000s, then I'd be really interested. I'd be selling all of that stuff off, and I'd be allocating the vast majority of it to stocks. So that is what I wanted to bring up today. Basically, again, the market is clearly overvalued where it's at right now. I still maintain my prediction we're going to see a pullback later in the spring or in the summer, probably similar to what we did last year. I think we had the bigger correction was in the summer. I think that that's more than likely. As far as the Fed goes, the Fed's still projecting 3 rate cuts. I think that that's unlikely. I think we're probably going to be more in the 1 or 2 realm, and it probably only is going to be 25 basis points each time. Like barring a major crash or some major black swan, we might not see a rate cut this year. This is something that I think is going to be something that people realistically are going to have to start pricing in. And again, a lot of people still to this day are talking about we're going to see rate cuts, and it's a certainty. It's not a matter of if, it's a matter of when. I think that is true. I think that the timeline is just going to be longer than what a lot of people are projecting. So anyway, that's what I wanted to bring up today. If you liked the video, please like, comment, subscribe. Any feedback would be very much appreciated, and stay tuned for more.